In a single year, rents in Miami have dropped 8%.
Rent prices are very high in South Florida. You were right. Miami, for example, is ranked the least affordable housing market in the U.S.
That might sound like great news for renters, but for investors, that's a major problem. As that is happening, vacancy rates on apartments in Austin have hit a national record of 15.4%. In Phoenix, rents are collapsing.
Rent prices are down 2.2% this year. Occupancy rates are also down by 0.4%. Even short-term rentals are seeing rents drop.
And nationally, insurance prices are going through the roof.
Insurance companies increased premiums in 95% of zip codes across the United States.
Between 2021 and 2024, annual premiums across the country went up by 24%.
This will likely have inflationary pressures on insurance, hurting multifamily, commercial, and residential property owners even more that are looking to rent out their properties. This isn't just a correction. This is death of 1,000 cuts for many investors that took advantage of record low interest rates in pandemic boomtowns. During this period, this was the biggest bet we've ever seen in real estate, a 50-year high in apartment construction nationwide.
Real estate experts say it is now on track to beat, in fact, a 50-year high. More than 460,000 new units expected across the country this year.
And from 2020 to 2022, everyone was moving to Florida.
There are many reasons why people are drawn to Florida.
Of course, the climate and, the taxes.
From January of last year to date, more than 500,000 people surrendered an out-of-state license and got a Florida one.
As a result, rents surged, up 29% in 2021 alone.
LendingTree reports Florida saw a 29% increase in rent since the beginning of the year. That is the highest in the country.
For context, normal rent growth is about 3%. So in that single year, rent went from $1,260 to $1,600. And from 2020 to 2022, rents jumped a whopping 36%. That's a normal 12-year period of rent growth compressed into 2 years. And during that very period, property values jumped 50% in Miami. This is mainly driven by decreased supply and increased demand. Investors thought they hit the jackpot. They started buying apartment buildings, single-family homes, multifamily properties. They thought rent was only going one way, and that was up. But now the music has stopped. Rents are falling and costs are exploding. And now many people are leaving Miami. There's a very big trend on Instagram and TikTok of all the influencers talking about leaving Florida. Many believe that it's because they simply can't afford to live there any longer. And people are just moving to affordability. But for investors, the math on these deals they bought no longer makes sense. So what happens when thousands of investors nationwide in 2020 sell their properties in LA, in San Francisco, in Boston, Philly, New York City, and Chicago, and they 1031 exchange, meaning they sell their property, they buy another property of like kind, they defer their tax liability by offsetting it into this new investment in South Florida with record low interest rates and sky high demand, forcing them to overpay for properties. And at that time, it seemed like rents were only going to go up. But now as people are moving out of Miami, moving out of Florida, insurance is going parabolic. You look at all the concerns happening geopolitically, then sky high mortgage rates, and they have a short period of time to refinance these loans. It's going to equate to a really big problem for a lot of these investors. In this video, we're going to break down exactly what happened and what I believe is going to happen next. And if we're at the start of a major reset in the single and multifamily real estate market, to understand what's happening now, we have to look back at what just happened. In 2020 and 2021, many high-income earners were looking for a few things. One was to reduce their tax liability. Two, have more freedom. And three, they were looking to buy and invest in real estate. And so people were moving to Miami, to Austin, to Nashville, and they were really buying as much property as they possibly could. But when you look at Florida, the amount of demand, you have 770,000 people move to Florida in a very short window of time. I'm talking about 24 months, 770,000 people move there. And investors, they saw this trend. They saw the demand to live in these cities, and they were buying as much property as they possibly could, alongside of these people now relocating there, and they were buying land to develop apartments. They were doing value add, buying these properties, fixing them up, and renting out these apartments, these units. Everybody was getting rich. It seemed like the party was never going to end. Multifamily sales exploded in Florida. There was over $11 billion in sales in the single year of 2021. Everyone believed rents were just going to keep climbing, and for a while they were right until they weren't. Between 2020 and 2022, in South Florida, rents jumped 58%. The average rent hit nearly $3,000. In Austin, rents jumped 35% in a single year from 2021 to 2022. In Phoenix, rents climbed 29% in a single year, making it one of the fastest growing rental markets in the entire country. It became this game of buy now. Raise rents 15 to 20% and double your building's value in just a couple short years. And that's exactly what people are doing. But here's the problem. Investors weren't just betting on rent growth. They were paying more for less return based on very low interest rates. Let's talk about cap rates. Cap rates are very simple to understand. A 10,000 foot overview, very elementary understanding of it. If you were to buy a building all cash, let's just call it $1 million building, and you were earning $60,000 a year on this property after expenses, your net profit. This does not factor in a mortgage. You make a 6% return, which would be a 6 cap, right? On $1 million building, if you're making $30,000 a year in net income, and again, this does not consider your mortgage, taxes, insurance, repairs, maintenance, things like that is what is factored in. On a $30,000 income on $1 million asset, you're looking at a 3 cap. And this also doesn't factor in for like roof replacements or any type of like CapEx, any involvement, anything down the road that you might have to spend. But just simple math, this is the return on cash that you would get if you were to buy out the building outright. When you're buying these properties at a 4 cap or a 5 cap, you're only making $40,000, $50,000 a year. If borrowing costs go from 3% to 6%, that's a really big problem, right? That mortgage rate is gonna double. If your insurance is skyrocketing during that period, there's not much cash flow to offset that expense. And when your rents are softening at the same time as all this is happening, it's a big issue that investors are dealing with in all these pandemic boom towns. It's I believe probably the biggest buying opportunity coming next couple of years inside of these areas. In 2019, properties in Miami, they were trading at about a 6 cap. By 2021, they were at a 3.5% cap rate. That means investors paid twice the price for the same income just a year and a half, 2 years later. They did this because they thought inflation was gonna be a really big problem, which that did happen. That is now the reality we're living in. But they weren't anticipating all the other changes. And so because of that, they missed a couple of key variables that I think will cost a lot of investors their properties. But what happens when their loan comes due and problems just continue to grow for these investors? The issue was not that demand did not exist, it was just that it was not going to continue to grow at that velocity to support those rents. In 2023 in Miami, rents started cooling. In 2024, it went into reverse. In Miami, a 2-bedroom averages dropped about 8%. 1-bedrooms dropped 6%. And that's just the start. Austin, once one of the hottest rental markets in America.
Austin has one of the largest rentership rates in the U.S.
Now with over 15.4% of all apartments vacant. Think about the size of that. If you have a 200-unit apartment building, 30 units are just sitting there completely empty. And so what are these landlords doing? They're offering concessions, first month, last month rent's free, free utilities. They're offering move-in specials. And many of these landlords, they won't reduce the rent unless they have to. That's the last resort. What they do is they offer these concessions to get people in the door so that they can show that lease at $2,000, $2,500, $3,000 to the lender when they need to refinance. If they were to drop their overall annual collection by, let's say, no concessions, but they just drop rent 10, 15, 20%, when it comes time to refinance, they have to show those losses. So they try to offer these quiet concessions to where they can try to maintain the value of their asset. But now it's just getting harder and harder and harder for these landlords to avoid just slashing the rents. Phoenix, Boise, and many other boom towns are showing 4 to 6 to 8% reductions in their rents. That big migration pattern is now drying up. Many people are moving back to where they initially moved from, or they're moving overseas or to a more affordable living accommodation. And in many cases, that is outside of Miami, Tampa, Austin, Texas, Nashville, out of these markets, and they're going to affordability. They're going where they initially moved from, and they're going back home. Florida's net migration jumped in 2022 to 314,000. Last year, it was only 64,000. And in 2023, it was 511,000. So it went from 314,000 to 500,000 plus to now just 64,000. It's slowly fading out. It's not a flood anymore. It's just a slow trickle. Meanwhile, during this period, investors were building everywhere they possibly could for a 2021 fantasy, not a 2024 reality. In Austin alone, there were over 54,000 apartments under construction at one time during that period. That's 20% of all available apartments under construction at the same exact time. I walked around Austin and I showed the amount of construction that was unfolding, and it was unbelievable. That much supply hitting all at once, just as rents fall and migration slows. It's a recipe for oversupply, lease-up struggles, and serious cash flow problems. And when your business plan depends on rents growing 10 or 20% a year, but instead you're offering concessions just to get somebody in the door, that's a huge shift. Falling rents are one thing, but what's really squeezing investors now are the newfound costs they did not see coming. Florida's insurance market is in chaos. Look at Glenn Kelman, the CEO of Redfin, and with Jerome Powell, what they both said. Glenn Kelman, he said in 2021 that in Florida, it's going to be very hard to get insurance and a mortgage. He said the only ones paying attention to what's going on with climate are the actuaries, the insurance companies, and mortgage lenders. Well, Jerome Powell came out a few months ago after what happened in LA and said that in the next 10 years, it's going to be nearly impossible to get a mortgage in high-risk areas.
You fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage. There won't be ATMs. There won't, the banks won't have branches and things like that.
How would you define California or Texas, certain parts of Texas, Florida? Some insurance companies, banks, they would consider those high-risk areas. So if the costs are going to continue to increase and they can't get passed on to the consumer, you're going to have a situation where a lot of these investors could be in really hot water, but you could see a big opportunity for new investors, cash buyers, to step in and scoop up incredible opportunities and great deals. In 2024, the average insurance policy was about $11,000, 11 grand. In 2019, that number was $1,988. It increased 500% inside of 4.5 to 5 years. Hurricane Helene caused $113 billion in damage.
Costs of the damage of Hurricane Ian in Florida, estimating here that Ian's damage could be more than $100 billion.
Hurricane Idalia hit the Gulf Coast hard. More damage, more claims, higher premiums. Major insurers, farmers, AAA, Bankers Insurance all pulled out of Florida or limited their coverage. Landlords and investors right now are scrambling. Many are forced into state-run options like Citizens Insurance, which some claim are more expensive and offer less coverage. And then there's higher property taxes. Yes, in Florida it's lower, but it's tied to your property's value. And as prices rose, so do those tax bills. Even with the homestead exemption, out-of-state investors got hit hard. Tariffs on imported building materials like lumber, steel, and aluminum also drove up construction costs. Tariffs on Canadian lumber alone up 34%. These costs trickle down, making homes more expensive and worsening affordability. The math no longer makes sense. Let's recap. Investors bought at a 3.5% cap rate, expecting rents to grow by 20%. Now you have falling rents, increased insurance, increased borrowing cost, and on top of that, you're having more supply hit the market than ever before. So you have this huge influx of debt to income at a time in which nearly almost $3 trillion worth of debt has to roll over inside the next 2.5 years. So at what point does this stop being an investment and start to become a major liability for a lot of investors nationwide? And here's the kicker, it can all be survivable if financing stayed cheap, but it didn't. From 2021 to 2024, interest rates more than doubled. And with over $1 trillion in debt needing to be refinanced in the next 12 to 18 months, most of it was borrowed at 3 to 4% or short-term debt. Many were even advertising interest-only loans. A lot of the big influencers were talking about how they were getting interest-only loans and this is the best way forward. Now, borrowers are facing 6 to 8% mortgages if they are lucky. Bridge loans and short-term construction loans are much higher. And their buildings no longer cash flow. Lenders don't want to lend on them, not with the debt load that they have in their capital stack on these assets in most cases. Many of these investors were buying value add. The plan was they'd buy a property with low rents that had deferred maintenance. They would do, Mickey Mouse repairs, clean them up, increase the rent 30, 40%, and they'd refinance out their money or potentially sell their asset, 1031 exchange on another asset. But many of those investors are now getting rug pulled entirely because the buildings today are worth less than the loans tied to them. And when their time is up to refinance, these investors, they have three options. They sell for a loss, they default and give the keys back to the bank, or they come up with cash themselves. But here's the bigger picture. This isn't just Nashville with 18,000 vacant apartments, or Austin, or Phoenix, or Miami, or Tampa, or any of these boom towns. It's what happens when an entire asset class is based on assumptions, and then the environment completely changes. These investors bought at the top, expecting a series of events to unfold that never materialized. And now with rising cost and refinancing risk, this is pushing forward a real estate reset. If you're in real estate, either investing, managing, or preparing to invest, understand this: the reset is already underway. What happens when buildings stop cash flowing? When owners cannot refinance? When distressed properties start flooding the market? I've been in real estate since the great financial crisis. I'm gonna tell you, I believe that we're gonna walk into something that's gonna be far worse than that period. In 2008, 2009, you had CNBC, you had the mainstream media outlets talking about how bad things were. The Dow was plummeting, real estate values, millions of foreclosures.
Not in generations has Wall Street absorbed the number of body blows it took today.
The American financial system is rocked to its foundation as top Wall Street institutions topple under a mountain of debt.
When you step back for just a moment, consider the events of the last few days. It is truly unbelievable.
I don't think we're gonna see that this time around. What I think is gonna happen is I think it's going to be a silent depression. I think big banks like Bank of America, Wells Fargo, JP Morgan Chase are going to be selling billions and billions and billions of poor performing, underperforming, or non-performing debt to large private equity firms, institutions, and corporations. And I think they're going to be doing this quietly. And assets are going to slowly get handed over to these corporations, and everything is going to slowly trickle away. Living standards are going to trickle away, and these big corporations are going to get a lot bigger. Now, why would this happen versus some loud crash?
For 14 years, he was the man in charge of the nation's fourth largest investment bank. Lehman Brothers, once worth more than $45 billion, went bust on a September weekend in 2008.
Well, if there was a loud crash, property tax revenue would collapse, and city collections, they would fall at a period in which social services are even further in need because most Americans are struggling financially. And I think the ultimate goal here is control and power, and it's pretty hard for that to unfold if property values are tanking. So I think we're going to start to see this, really challenging couple of years ahead of us, and I think it's going to be this massive wealth transfer unfolding. Now, as that's all happening, I do believe this is the biggest real estate investing opportunity in American history. And I think that those that are making smart and ambitious decisions and really, really investing properly today are going to be way better off than those that are sitting on the sidelines. The key is owning the right assets, ideally fully paid off or no debt, or if you're going to put debt on them, fixed rate debt. You're not going to have 3-year, 5-year debt you need to refinance, or construction loans or hard money loans you need to, get out of in the next 6, 12, 18 months. You want stable debt, stable payments, and you want a great plan. If you want to learn more about what I'm doing, you can click the link in the description. I relocated my entire family to Ohio because what I believe is going to happen is we're going to see this huge migration of affordability. Everyone's going to be leaving these expensive cities, and they're going to be going to a place where they can afford to live. That's my bet. And if you'd like to learn more about it, you can go to singlefamilyinvestors.com. You can click the link in the description just below this video. Schedule a free call if you have 100K or more. Catch you next video.